Welcome. This is Todd Gordon, joined with me, as always, Ryan Bouchey. Welcome, man.
What's going on? How are you out in upstate today?
Well, we had some computer crashes. It could be the woolly mammoths walking around on the internet cords out there. It could be the polar bears chewing on the wires. So this is take two from the live stream. So we just figured we'd take it offline, do a recording, and get this information up to you guys. So this is the recorded version of Thursday Live with Ryan and Todd, yet to be named. We got to come up with a better name than that, but there's a lot of
Yeah,
other
we'll
things
we'll,
going.
we'll work on the details as time goes on. We're still early in the mix here.
Exactly. So let me just flash some disclaimers here quickly. I believe our voices are going to go quiet. Important regulatory message that we got to get to you. So let me just do this right now. I don't think, actually, you can still hear us. So just important to take a look at those disclosures. They will be also posted down below in the show notes. So welcome to Thursday after the close, another crazy busy day. Ryan and I always joke since we launched this thing, man. It's, as soon as Wednesday comes around, we say, can't believe it's already Wednesday. And then comes to Thursday and we say, all right, slow down. And then Friday, we say, where did the week go? It's a function of
Well,
the markets we're in and starting this new business. Boy, literally, you wish the time to slow down, right?
we got to get time to slow down. We got to find different days to tape, or hopefully we buck this trend because the last two times we've done it, we did it Friday at market close, and we're doing it today at market close. And we've had some steep sell-offs into both of these markets, unfortunately. But to your point on the business end, I mean, we were talking before, just before 4 o'clock, and I'm like scratching my head at where the week went, working with a ton of clients this week, bringing on board some new clients, and the time is just flying. So getting things going, and we officially launched, I think, 2 weeks ago now, and it's just it's not enough time in the week, and the weeks do blend into the weekends a little bit right now, and that's okay. Just a lot to do, and a lot of fun though along the way. So it's all good. It's
That's what I'm saying. We're having fun. I mean, can you imagine? Here's a question for you. When's the last time you've been bored? Can you remember that?
yeah, it's been a while. I haven't had time to sit and be bored. It's just
Well, it's sort of
cranking.
like it's got to be years. I mean, listen. Everyone listening is probably family responsibilities. Like I don't know. I'm sure most of the people listening I could share that sentiment, but I honestly can tell you I don't remember the last time I was bored. I mean, maybe
Yeah.
that's just a function of who we are, but yeah, not complaining. We're having fun. I mean, you
Oh,
don't
it's all
have
good.
lousy weeks and have them fly by. Usually, if things
No,
aren't going well, they drag. So, yeah,
exactly.
markets are busy. We just want to talk about a couple things. We rebalanced the portfolio, both portfolios for clients. Talk about that. Ryan's got some really cool topics in light of market volatility in terms of planning. Want to hit on that. Want to talk about kind of the state of the economy. Obviously, Russia. The news is very fluid as we go back and forth. And I, as a trader, Ryan, I'm not going political here, but I always like to hear what both sides are saying. The way the news is being reported, because this is obviously, we know inflation is driving, rates are going up, Fed's going to hike rates, but it's a very geopolitically driven market, and the way it's being reported, I think, as an investor or a trader, it's very important to hear what both sides are saying. Not a political statement at all. So let's just do this. Let's go on one side. Let's take a look at what Fox News, any topic on anything on Russia here, I should say. Biden is right about Putin's plans for Ukraine. Okay, not much. I was seeing a few more headlines that were trying to indicate from Fox that it was tense. It was very tense. And then flipping over to CNN, USS says Russia plans to manufacture justification for war. So it seems to be on both news sources on two opposite sides of the spectrum. I saw a headline earlier on CNN that it looked like, oh, it's right here. I'm sorry, I missed it at the bottom. Oh, it flipped out there. Now we're back to Fauci. It's interesting. Fox doesn't have anything up there.
Yeah, I had a headline just an hour ago when we were doing
Yeah.
when we tried going live with it, but
Yeah. What was the headline? I don't even remember. It was also sort of, it was trying to
it was along
indicate
the
that,
same sentiment as CNN. And
yeah.
I was actually just thinking about it because you were talking about how the market is trading right now and moving based on a lot of this geopolitical talk and issues, obviously in the news with Ukraine and Russia. We haven't really seen the volatility from geopolitical since I think the true volatility that I can remember was maybe back to the trade war negotiations, which
Back
when was that? Late
it,
2019. It was right before
eight.
pre-COVID, probably
I
2019. That was the last I feel big geopolitical, worldly issue that kind of had the similar impact on the markets, if you will, that really kind
it's
of
a,
dominated the market discussion.
yeah. I think it started back in 2018 at the same time
Yeah.
when I think when the Fed started raising rates in 17. I think Jay Powell started raising rates in 17. I think 3 times, and then 4 times in 18, in the midst of a trade war, and Trump was just destroying Jay Powell.
Yeah.
I think you're right. The last time it was geopolitical tensions, and yeah, yeah.
And
Just go
it's
ahead, man.
it's been an interesting topic too, because I mean this the headlines out of Ukraine and Russia were really driving the markets on Friday when we were last here talking about it, and Friday had a pretty massive sell-off heading into the weekend. We got back to Monday, headlines kind of eased up a bit, wasn't seeing the same aggression or maybe a little bit of a pullback. And we were talking over the weekend, even Friday night, a little bit about how, from kind of what we following outside of the mainstream media, things didn't seem as bad as what everyone was making it out to be. Didn't kind of get the same sense of the aggression and issues that were coming to light through the headlines. And so, I think right now it feels as though one of those times where I try to take it with a little bit of a grain of salt in terms of what's actually happening and
Hmm.
what the repercussions are going to be. I think this is going to be, more of a minor blip than anything at this point. But obviously the market is reacting in real time pretty quickly, both on the positive. I mean, we started the week off great, and all of a sudden the last day and a half, we're seeing some declines, especially the end of this afternoon really kind of sold off heading into market close.
Yep, yep, absolutely. And just we'll talk about some of those things. That's well said. We'll talk about some of the things that are driving on the economic front. But let's just take a look at just a simple chart. So this is the Nasdaq. This is a half day chart. Each bar represents one half day. This is sort of the double top that the Nasdaq saw here in November and December. Have been selling off in 22, and then this is the bounce that we're seeing. And this is what is somewhat concerning, is when you have sort of a feeble bounce and come back, test the lows. Could we have another leg lower? We certainly could. And to your point, it seems to be more geopolitically driven, because we're seeing a lot of stocks sell off. But you were going to say something earlier. Go ahead.
Yeah, I just noticed it into the close. I didn't read much about it, but I did see, through the headlines and in reading a little bit, the sell-off obviously was driven, I think, by news out of the headlines out of Russia and Ukraine. But oil on the flip side
I was just going to say that.
closed the,
Yep.
closed the
Go
day
ahead.
down, and
Down.
you would have
Yep.
thought you would have seen oil in that kind of circumstance really spike. And just kind of thinking about it, I wonder if there's more of a overreaction to the headlines with the overall stock market. Maybe things aren't as bad as they seem based on what oil is doing. And again, I'm kind of speculating there, not really getting into the details of what could have been driving that. But I just thought it was a sort of an interesting
Yeah.
disconnect with as much as the market did move today.
Yeah. No, it's a good point. Yeah. Crude Crude really seems to be having a hard time with this 95. It's kind of messing around here. And this is just a quick look at the sectors today. Biggest loser was technology, down 2.9%, then consumer discretionary, then communications, financials, industrials, materials, health, real estate. Winners were staples and utility. If it's truly geopolitical, right, I think this is maybe where we're going with this. I would expect to see, energy, where's XLE? Energy was kind of flat in the day. Technology, discretion, and communication selling off, those are more of that's not geopolitically related. I almost feel like it's just sort of additional position squaring heading into Thursday for the end of the week. I don't think everyone wants, if somebody wants to get out of stock positions, they're not going to do it right at Friday at the close. They're going to get out Thursday and a Friday. Don't want to take the weekend risk. I would have seen some, I would expect to see some different names rather than technology leading. And I just think it's more risk aversion. Bonds were up pretty significantly today. 30-year was up 0.85% on the 30-year. The actual bond itself, the 10 was up 0.5%. Here are the yields. Yields are down 3.6 on the 10-year. 30 years down 2.24. So yields were down. Crude was down. Tech was leading it. Discretionary was leading it. It's interesting. It's interesting. Anything you want to say there? Is there anything sticking out to you? I think you're making some good points here.
No, nothing on today as much as kind of just more maybe big picture sort of economy and how it's affecting the market right now. I think we're seeing, a few different areas. I know we were talking earlier and I had mentioned, kind of this disconnect between consumer sentiment versus the economy a little bit. And it was really interesting just seeing where the consumer sentiment numbers are right now. We're below where we were at the peak of COVID. And I say the peak of COVID in terms of where the markets were around March, April of 2020. I think we bottomed out in March of 2020 in consumer sentiment has dropped below where the levels were there. And I think it's the lowest we've seen in almost 10 years. But on the flip side, we've had really strong economic data coming out the last few weeks in terms of looking at the jobs reports. We've been adding jobs the last few months. Yep. Spending has been up in January. We're seeing continued spending. I think we saw a little bit of a dip maybe beforehand, and some of the economic numbers were a little shaky for a little while in the midst of Omicron. But feels like as a country we're kind of coming out of that. Again, we keep saying getting back to more of a normal routine. But it is interesting where consumer sentiment is still as low as it is with some of these other factors that seem really strong.
Yeah, and here is that consumer sentiment. It's, obviously I didn't have consumer sentiment. It's just magically queued up. We're trying to stay on point here, and this is something we wanted to talk about. Ryan brought it up. It's a good point. So this is your consumer sentiment. Just came out here, I think February 11th, and it printed a new low below COVID lows, a significant low, down to 61.7. If you go out in the max, you're reaching credit crisis lows. What? Credit crisis lows? Before that, we're down around, that's mid-70s, stagflationary 70s into 1980, but we have a double bottom there in 2009 into 10, and we're not too far off. It's got to be just finally we're starting to see the inflation numbers tick up, yields going up, Fed's going to raise rates. Let's talk about that quickly. We can look at the Fed funds calculator, and it's got to be a large part driving sentiment. And I don't know if we're going to have time to go into it now, but I'm seeing a couple technical sort of what am I saying? Some internal indicators, some breadth indicators, advanced decline, stocks above the 200-day, below the 200-day. There's a lot of oversold reasons in terms of stocks that have been laggards, that are not making money, high valuation, growth stocks that have been really beaten down. And it's starting to really weigh into these sentiment technical indicators, not so much consumer sentiment, right? But looking at the technical picture of the market, it's getting pretty oversold. And look, inflation is not only high, but it's going higher in a very sharp rate, right? It's like central banks don't like when interest rates go up quickly. It's okay to have measured increases both in the short and the long end, but central banks, it's really hard to plan when rates go up quickly, and inflation's gone up very, very quickly. So the other thing we're dealing with here in the March meeting is the chance of a 50 basis point hike. So here is the March 16th meeting. That's interesting. I've seen this chances of a 50 basis point hike as high as 39 or 40%. So we've actually backed off quite a bit from the 50 to 75. That's interesting. So right now, instead of 0 to 25, this was actually a lesser odds going 25 to 50. Now it's more. So there's been a swing here, interestingly. A lot of people were talking about 50. Looks like the market's only pricing 25. I didn't know that, right? That must have been a recent sort of move in the Fed fund futures markets.
And I'm sure, I'm guessing with, as we process all the news that's happening and we're seeing overseas, I'm sure that could continue to shift as on a day-to-day, week-to-week basis until we get to that March meeting.
Yeah.
And I think in terms of consumer sentiment right now, one of the biggest things and fear for spenders and individuals is inflation. I mean, I think there's this huge worry and concern about what inflation is going to do. I mean, we're not seeing it slow down spending by all that much. And even, I saw headlines today or yesterday, some of the biggest, Coca-Cola, Disney, Airbnb, they're all saying they're seeing still that pent up demand for spending. And so we're not seeing it really slow down right now, but there's an underlying concern and underlying fear that, not only is inflation going to eat into people's spending power, but also what's the consequences of it, right? With the Fed and when we start raising rates and, with the dual mandate to bring inflation down, obviously rates are meant to slow the economy to a certain degree, right? With whether it's through hiring or the overall spending nature of the economy and get more people saving with higher rates. I think that's where some of the fear lies right now. And, when I go back and you were talking about kind of what we saw back in 2017 with the previous cycle of interest rate hikes, especially early on, I mean, I don't want to say it's got to be a good thing, but you typically see some of that short-term volatility. However, if the Fed is raising rates, it means that the economy is doing pretty well, and there's a lot of strength there for them to make that decision. So it can be good and bad. I think in the short term right now, obviously we're going to continue to see volatility and we're going to see how this market plays out, but doesn't necessarily need to be a bad thing just based on what the Fed is doing. If you're a longer term investor right now is what I'm, seeing and kind of my take on that.
Yeah, no, that's a good point. I think, I think it reflects portfolio we changed. The one segment, the one sector of the economy that I think that is being impacted by inflation is housing, and the way rates are going. But you're right, companies who are able to navigate through supply chain issues, who are able to have pricing power by passing prices, their higher input costs obviously will drive the cost at the register. They're able to pass off that cost and keep their margins somewhat elevated, and that's been the focus of this earnings season: is how are the margins on companies, and input costs go up, but the prices have gone up, and the consumer continues to pay it. I think the one exception, it's a good point you make, and the one exception is as you said, is the housing market. So this data point, housing starts, just came out. And we're kind of topping out here in purple in housing starts, 1.75 million. That was in March of last year. And then we just came up into November and December, sort of topped out there in terms of housing starts. And here is the 30-year mortgage rate. So 30-year mortgage rate, I just saw a thing on CNBC, was up to 4.05% was the average 30-year rate, and they also the mortgage, a conforming loan mortgage, just hit a new high in terms of the average borrowing costs. So, housing inflation is really starting to see buyer slow down, and also supply. Housing supply is another issue, but the cost of money is going up, as you can see here in the 30-year mortgage rate. And here's a little aside. The best way to track the 30-year mortgage rate is just simply look at the yield on the U.S. 10-year note. the U.S. 10-year note doesn't make sense because there's a 30-year bond, but the 10-year note dictates the price, and the 30-year mortgage. If I put a overlay on them, they would be hand in hand. So, the other thing is. Refis, the last report on refinances just saw it drop by half, more than half compared to this time last year. So refis are going down. The housing market's slowing down. I just did CNBC today. We're talking about Redfin, which is like a $3 billion, online sort of discount broker for real estate. But, we moved, we had XLRE. I didn't hold individual utilities in the portfolio, but we just we dropped it. We had 2.6% in the S&P. So this is actually growth. Sorry, nothing in growth. Here's dividend. We dropped the real estate holding in the dividend. We were holding XLRE, which is the ETF that tracks real estate. We're holding individual. I just wanted a little bit of real estate exposure, and we just dropped it to zero, even the dividend, which is pretty impressive because we actually are starting to see rotation out of real estate. Real estate outperformed the benchmark S&P in 21, but into November and December, we're actually starting to see real estate stocks, including REITs, drop relative to the S&P. And if rates are going to go up and supply is an issue, and you look at the price of lumber, which is spiking, you can't think the supply issue is going to get any better. So I think it was a good move to sort of rotate out of real estate. But Ryan,
Yeah,
what do you think?
the market's going to continue to be forward looking on that. And, the real estate market in this country, I mean, we really haven't gotten to, especially for when you talk about like home building starts and housing starts. I mean, we really haven't even recovered from, the financial crisis of '07 into '09. We never really saw that pickup in terms of being at the level that we need to keep up with population. So that's going to be an area that's going to be really interesting. I saw, rates jumped in a week, almost 25 bips. We're up more than 1% from this point last year. So rates are rising pretty quickly in terms of the mortgage lending rates. But there's a lot of people. I'm going through right now in Boston. There's a lot of people still looking to buy. I don't know. My feeling on this right now is that I think those stocks are going to have a hard time kind of overcoming some of the rising rates. I don't think we're going to see a complete sell-off in the housing market in terms of drop in prices, but I do think you'll probably see more of a plateauing. Your refinancing, that's going to drop precipitously if we're rising as fast as it is. I think a lot of people took advantage over the last 2 years. I know I've talked a ton about that with clients. It being at these historic lows. It's going to be interesting how this all plays out because there's still so little supply and a high demand that the market is still there, but rates going up, it's going to hurt purchasing power tremendously. I mean, that's where you see it. I think that's what's been keeping prices high is people can stretch a little bit because rates been so low, but as they go up, we're going to see, to me, I think we're going to see more of a plateau than a bubble in the housing market. But I think it's going to be some years for it to play out.
Yeah. You got to think about it too. Coronavirus cases have just as quickly as Omicron came on, Omicron is coming off. Mask mandates are coming out, and you got to wonder, our companies, as quickly as this thing, hopefully, knock on wood, is disappearing, our company's going to start bringing people back into the office, and the great resignation that we're seeing, the work from afar, work from home, maybe that's not here to stay. And I have to think that the metropolitan areas have been suffering as the suburban areas are being bid up in prices. Lord willing, we're through this pandemic. Again, maybe more pressure on the real estate market, at least in housing, and not so much, in the city living. And then the other part. This is the piece that I put out on our website, newAgeWealth.com. This is just the 30-year yield. I always like to look at this long-term yield, and it's amazing. As many people have said, rates are spiking, and we're the downtrend in yields and rates, which they're all correlated to some degree, is over. And just look at a simple technical take. We're a long way away from losing the trend line here. Let me pull this over here. We're a long way from losing the trend line. So 3% on the 30-year, 2.95 area. That's where I'd start to say, okay, maybe we have seen a reversal of a 4-decade reversal in yields. And, we're a long way from an inverted yield curve. I don't think the Fed's going to let that 10-2 spread get too tight. That inverted yield curve has been a telltale sign of a significant reversal in the market in 2000, 2007, and plenty of times prior to that. I don't think the Fed's going to do it. And the fact that we just saw on the Fed funds calculator such a reversal from going to 50 bips in March to 25, there's been a pretty significant scaling back of how much rates are going to go up. And I don't think a lot of people are talking about that. In fact, I haven't looked at that in a day or two. Those have reversed quite a bit. So that's going to be interesting. And again, I can't help but think maybe just with tech, consumer discretionary communications down so much, maybe it's just position squaring on Thursday. Maybe we'll see a little bit more Friday. People just don't want to take risk home over the weekend.
Yeah, no, it's a good point. And bigger picture, even where we are right now, we were talking about this. I mean, the S&P is down probably close to 10% now. NASDAQ is 12, 13%. I was looking at it earlier this afternoon. But generally speaking, this is pretty routine, run-of-the-mill type of pullback, right? This is, if you look back 35, 40 years, this is essentially what we average on a year in, year out basis. It doesn't happen every year, but when you look at it from the S&P perspective, it drops about 14% on average per year from its highs to its lows. Doesn't mean it ends at down 14, but you see that sort of movement in the market on the downside. And so we're still in the middle of that right now. And I do think you'll see probably, as we look at the portfolios too, and kind of doing some rebalancing, there's going to be some winners and losers through an interest rate environment like this. I mean, there's no doubt that it's not going to be, all in the same, direction, if you will. But, I think that's kind of where having a little bit more, being a little bit more nimble, a little bit more tactical with some of the active management we're doing right now, being able to kind of come in and out of positions and not be all in, in the market is beneficial. We can kind of make those, choices, see how it plays out. And like I said, just be more tactical from an overall perspective.
And that's always, always what that was the mandate. I think that was the mandate we put on ourselves. That's the way we launched it, and we identify ourselves. We're going to be tactical. We're going to be active management. Doesn't mean we're going to be all in or all out, but we're constantly going to be, increasing weightings, decreasing weightings. And before we do that, I do want to show the portfolio quickly. And there's a planning strategy that I really want you to talk about before we get too long. We're already at 27 minutes here. It's amazing how quick this goes. But I'll forever be a technical guy. Obviously, I'm doing a lot of fundamentals, but just take a look back and say, how many people are declaring that the next bear market is here, and just step back, close your eyes, take a deep breath, look at this chart, and say, when I look at this, I say, that's it. I mean, the market is up. This is just the S&P. The NASDAQ's going to be more. The market was up 120% from the COVID lows. Currently, we're up 100% from the COVID lows. And if you look at the distance we've traveled, it's amazing. But, we've seen a 12% drop in the S&P, give or take, to Ryan's point. It's close, good enough, 12 and change. Right now, off the highs, we're probably... Are we less than 10? Yeah, we're 8.5%, 8.8% off the highs. NASDAQ's a little bit more severe on terms of how much we're off, but, oh man, I'm sorry, guys. I wasn't showing the screen. Sorry. The numbers stand here. Sorry. 120% from the lows. We're off 8.5% from the all-time high. The NASDAQ, the drop has been larger from the high, but also the gain from the COVID lows has been much more significant. So, if you are playing the longer term game, the gains that you've seen have been significant. And let's talk about this real quick. I want to go back to the point that Ryan was making in terms of being tactical, being able to allocate in and out of sectors and industry stocks are working. We're not trading it. right? We're not in and out of this market. We're shifting a couple percentages out of tech into energy, out of communications into discretionary or into healthcare, moving some stocks around. That's what we're doing. We're not in and out. The pace of information and the pace of marketing that we're doing here is it's very quick, because that's the kind of market we're in. We're in the digital information age, but also we're in a very busy market right now. So the pace of information is very quick, but we are moving slowly with the portfolios. We are, we're being tactical in what we're doing and not overreacting. So that being said, let me just show you real quick. And Ryan, if you want to jump in, please do.
I was just going to say, I mean, I think in terms of the pace that we're trying to put information out, right? Being able to do this on a weekly basis, it's just great to touch it, touch our clients, let them know what's happening, talk to the public about, what we're seeing in the markets and the economy. It doesn't mean we're trading on every, daily headline or every daily movement in the market. It's just more, hey, this is what we're seeing. This is what we're, taking in and sort of digesting in terms of the information that we get, and hopefully to help make better decisions, take into account, some other planning topics that can come into the mix with, both the markets, the economy, and just kind of keeping the investors out there on top of how we're, viewing the information that's out there. And there's a lot of information, and it can differ greatly depending on where you're getting it from, who you're following, who you're listening to. But just, I think doing this on a weekly basis is awesome, just to, talk about the market. I mean, we live in the markets. And again, it doesn't mean that we're trading day to day, hour to hour, week to week, but it does mean that, hey, we're on top of it. If there's reason to, make a shift, make a tactical move, again, whether it's cash or positions, whatever it may be, we can do that. But, just talking about it and kind of going through, hey, what are we seeing out there? I think it's so important, because like I said, if you focus too much on the headlines, it can lead to some bad decisions on a certainly day-to-day basis.
100%. I mean, it's, not blaming any particular news media. It's just news in general, and it's our short attention spans in the digital information age. The pace of information and the quantity of information is coming at you so quickly, and it's so voluminous. How's that word? Voluminous. That unfortunately the headlines are tilted a little bit more sensationalistic to grab your eyeballs. So the publisher or the social media influencer or the media outlet ups their ad dollars. So it's really important to piece through. And a lot of the clients that are coming on in the early days here to New Age were with me in the old trading business. And, a lot of them have said to both of us, Ryan, they're like, look, I can't do it anymore. I can't keep up. The market 2-3 years ago, it was easy. Buy NVIDIA, buy Apple, buy XLK, buy QQQ, and just AMD, and just do nothing and just make money. It's a different market now. Yeah. It's a full-time job to keep on top of this market that is constantly changing. It'll settle in. We're having a little spike up in volatility, but it'll settle in. But it's a challenging market. A lot of clients are coming to us. Are saying, look, I know you're all over this. Just you guys deal with it, because it's too much for me. I have a full-time job. I have a family to take care of. I want to enjoy my retirement. You guys watch it. I'm looking at myself. This looks like I'm a college kid who crawled out of a dorm room that hasn't showered in 2 days. I did shower this morning. It worked out. This is what I look like. But that's kind of market. That's kind of market we're in. So Ryan looks good though, doesn't he? It's just he's cutting.
You're in upstate. I'm in Boston. I'm in a bigger city. I got to keep it a little different pace here.
That's awesome. All right, real quickly, and I want to turn to Ryan on this. So couple moves. I wrote a long piece about it, and you guys have access to this. And the other thing, clients, I will be sending you the dividend and the growth portfolio breakdowns, so you can see which stock belongs to which portfolio, because I know it's confusing if you have a blend between the two. It's hard to tell. So the big changes in the dividend portfolio, as I mentioned, real estate, we cut real estate, which I think is interesting. Materials, we cut 2.7% down. We're only at a 2% now market weight in materials. Again, it kind of goes into the energy, play. Energy, we maintained in the dividend, but we cut in the growth. And we've been very long energy for since inception, and we've done well with it. Devon has been a great one, and it continuing to make new highs. But I think it's time and prudent to scale back. Crude continues to struggle around 90, 95. I do believe ultimately supply chain issues will go up. Crude should be ripping a lot higher if the news are as bad as it says. Europe, and I've been watching natural gas. Europe could suffer if Russia does invade. It can shut off the pipe that goes through Ukraine that feeds Germany, and Russia is a massive producer of natural or supplier of natural gas to Europe, and the energy markets are doing pretty well. So on top of it, it ties back to that 30-year yield and the 10-year yield, which has moved higher, but is still well contained within downtrend resistance. Don't think the Fed's going to let long and short-term yields get too close, which is a flattening of the yield curve. All of that ties into the energy and the materials play. So we cut materials by 3%, cut energy by 3%, which is a pretty big move. We're still overweight. We're still 10.5% energy allocation in the growth portfolio, which is overweight the S&P by 7%, but we did cut it by about, a little less than 30%. So 25 or 28%. So 13% down to 10.5. Materials, we're at market weight now. We were overweight, same story. Consumer staples, sort of a flight to quality. Companies making money, who have supply chains well in play. They're able to pass off the prices because they are consumer staples, a little bit more fairly valued rather than high-flying stocks. We do have a Costco in there, which considers a consumer staple. Up financials, rates continue to go up. Financials are continue to be strong. We are a little underweight, though, relative to the benchmark in financials. And technology, I cut back a little bit here in growth, but we're still significantly overweight tech in growth. Dividend, though, the big move in tech was we upped by 8.5%, which is pretty significant. And not a lot of people are talking about rotating into tech right now. Ties in energy materials. I think we're starting to see evidence that tech, I think if we can get through this Russia-Ukraine issue, we might start to see tech come back. Earnings are strong. Look at Apple. Apple relative strength was just absolutely impressive. We've seen some big up days in the chips like NVIDIA and AMD. So I think I might be early. I'm pretty sure I'm going to be early in tech, but that's okay. I don't want to have to react quickly to get into tech. So up tech, up staples, as I just mentioned. There's some really good names in staples we added to the portfolio. And in the lack of real estate, we brought in some utilities to get a little bit more yield here in the dividend. So I just wanted to show you that and quickly turn it over. Long video, but there's just so much to say. If you've made it this far, thank you. We really appreciate it. Ryan, do you want to take us in the close and just hit that?
Yeah, why not?
Yep.
Why don't I tease us a little bit with something I'm writing about? So I'm gonna include it with our newsletter going out at the end of the week. But we've talked about it with both clients. We've talked about it amongst ourselves. But tax time. Everyone's kind of getting last year's tax reports, doing a lot of their 2021 tax reporting and filing taxes. But it's always a good time to kind of be thinking ahead and thinking of the current year into 2022. And so talking with clients a lot about Roth conversions right now, and for multiple reasons, right? We got this great software right now that's helping us really, one, do tremendous tax planning to help really get our numbers right when it comes to conversions, other issues in terms of taking in income and versus deferring income. But we're also doing some pretty in-depth planning when it comes to kind of the cost analysis of what a Roth conversion looks like. And so, I bring it up now with everyone kind of getting into 2021 tax filing season, because with the markets down, we're talking about the volatility right now. I always like to consider Roth conversions, especially when we're seeing this type of volatility that we're seeing. And so markets being off, 8, 9, 10, maybe even a little bit more, that's a great time to kind of lock in some of those losses in the traditional IRA, right? Move them over to a Roth. And make that conversion. It's a good time for it. If you're planning on doing a conversion for 2022, take a look at it. Right now is a great time. We're going to be reaching out directly to clients to start planting the seed to start doing this. I just think it's an opportunity right now with markets off, and then you take advantage of the bounce back or the growth whenever it may happen. But it's a good time with markets off their highs to start thinking about that. So for 2022, a little bit of a tax planning guide right now, we can start thinking about it. And I'm going to write a little bit more about when it makes sense, what we're thinking about when we're making those decisions, and really the technology that we're implementing right now that we could really do a great job working with clients to help them, find the right number to make that conversion. So a lot of gray areas with it. It's not as simple as black and white because we don't know what the future holds, but a lot of opportunity to do it right now. So, look forward to, working with our own clients and, diving a little bit deeper into some of these issues.
So cool. I can't wait to read that piece, and that's interesting. I'm learning from Ryan. Obviously, I've spent my whole life chasing the markets, and Ryan's been a ton of big firm RA experience on the investing and the planning side. So that's why we're very proud of the offering, and we're early in the business, but appreciate the client support. If you watch this far, man, appreciate it. You really are supporting us, and bright times ahead. Things are looking great despite the little bump in the market. But obviously, we're looking out on both the investment and the planning side for our clients, working closely. And thank you guys for sticking with us. If you're watching on YouTube, maybe just tickle that thumbs up button. Let the big Google algorithm know that this might be useful and somebody else might benefit from this as well. If you have a question, comment, please write it below. We will address all comments and questions below. You can find us at newagewealth.com if you have not done so already. Let me just bring this over, and be sure to get on our email list. We'll send maybe two-ish emails, 2 to 3 a week. Usually there's what we feel to be good content in there. So right down at the bottom, throw your name in there. We don't sell the email list. We'll just send you hopefully content that we feel might be of value. And check us out if you want to book a meeting to discuss anything with Ryan and I about potentially working together as we get to know you. Just hit that work with us button right there. Find a time that works for you, and continue through that process. So thanks, Ryan. Great stuff. And we will not have a live stream next week. Maybe we can. I'm going to be traveling. I'm going to be, I think, my first vacation, Ryan, on a plane in, I don't know, years. We're going to Park City, Utah. We're going to ski.
Awesome.
I'll be working. I promise. Bringing the laptop. I'm not leaving you. Maybe we can still do the live stream on a laptop. So we'll announce that through the email as well.
Perfect. We'll catch up. We're going to be talking later, I'm sure, today and into tomorrow. But everyone else, have a great weekend, and thanks for joining us today.
Sounds good. See you guys soon. Thanks.
Right. See you, bye.